Hello and welcome to the Ditto educational series that will provide you with the skills you need to become a Forex trader. Today we will be discussing leading versus lagging indicators and some examples of what that means and encompasses. Generally, new traders tend to learn to use the indicators that are based on previous price action when they initially develop their trading plan. Now, there is nothing necessarily wrong with lagging indicators, and many of them certainly have their place within our trading strategy. However, there are other indicators that serve us to see where price is likely to be predictively, by which I mean they can help us to anticipate problems further down the road. When novice traders decide to begin incorporating charting into their trading, most are not really sure where to start. When traders are sifting through the plethora of information online, generally people are directed to the most popular indicators such as relative strength index or moving average convergence divergence. Generally speaking, indicators that show you how the markets oscillate up and down. What these indicators have in common is that they use the recent historical data and price action to anticipate immediate market prices to follow. As far as our lagging indicators are concerned, there is nothing especially wrong with looking at the most recent periods in the market to determine aspects like whether the markets could be trending or ranging. In fact, this is often the best method to determine quickly the context for what is most likely the current state of the market. When entering trades, we may be more successful when we do this through price reacting to our leading indicators. The basic function of a leading indicator is to help you see how price could unfold. Let's now look into some of the most popular leading indicators and talk a little bit about them so you may come to understand their use and application. As always, we want to choose the correct leading indicator for our trading style and personality so that we may better resonate with it analytically speaking. Firstly, we have pivot points. Pivot points are excellent for Forex traders, and I think it's fair to say they are one of the most objective and leading indicators. Pivot points are taken from crucial previous price points in the market, and then a calculation is plotted on the chart when applied to give you three key levels. The pivot point sits in the center of the calculations with resistance points or profit targets for buy trades above the pivot point and support of profit targets on sell trades. If we were to believe that any given pair is likely to move higher, we could target the green resistance levels and put a stop below the lower support level. Obviously, we have to take into our account our risk management rules and trade accordingly with those. Next, we have ELLIOTT wave. ELLIOTT wave is another massively popular leading indicator. ELLIOTT wave theory is predictive and shows how the market trends and how corrections may unfold. The main aspect to the theory is that a trend is subdivided into 5 waves, with each wave displaying distinct characteristics under analysis. ELLIOTT wave theory is rooted in one of my favorite analytical tools, which is the all-powerful Fibonacci ratios. We have another video regarding the use of Fibonacci retracement to pinpoint entries, and I advise you go watch that when you're done here. A common ratio that is used to define a profit target in ELLIOTT wave is that wave 5 often travels 61.8% of the distance covered in wave 1 and 3. As we know from our previous discussions on Fibonacci, 61.8 is the most prolific number in its sequence. ELLIOTT wave is quite a difficult and prolonged subject, and traders' analysis based on ELLIOTT wave will differ depending on their skill level. Finally, now we will look at sentiment as a leading indicator. Trading with sentiment may seem odd to traders when they first start looking into it, mainly because the trading signal comes from analyzing sentiment and taking a trade in the direction of the trend contrary to the majority of traders or investors. So in other words, if we see that there is a strong uptrend but the majority of traders are shorting the market, then we would look to enter against the majority and continue to trade in the direction of the trend. Why exactly would we do this? The reason that sentiment is considered a leading indicator is that it is used on the premise that the trend will continue along its path. Traders who are fighting or entering trades against the trend will only prolong its natural path, and as they exit their trades against the trend to prevent themselves from losing more capital, the trend will continue on, usually in spectacular fashion. In summary, indicators are never absolute and need to be used properly within your respective trading plan. Indicators exist to help us see glimpses of possible outcomes based on previous data and theories rooted in collective data. There is no certainty that lagging or leading indicators can provide. However, leading indicators may be a helpful addition to your trading arsenal once you have properly learned how to use them. Now, please take some time to think about the ideas we have discussed today, how they apply to the Forex markets, and how you may apply them in future. Please sit back and contemplate what you have learned today, and remember, contemplation is the key to learning.
Thank you for watching the video. If you enjoyed our educational sessions, then please like and subscribe.